I'd like to share with you two very powerful quotes from two of the richest men in the world. One is John D. Rockefeller, who was one of the richest men in the world, like, a million years ago, 100 years ago, something like that, right? And he said the way to make money is to buy when there's blood running in the streets. And when people are panicking, people are fearful, that's what things are really cheap at a discount. That's when you buy, right? That's when you get a good deal. And Warren Buffett is famous for saying, be fearful when others are greedy, and be greedy when others are fearful. And now people are fearful, so it's time to get greedy, right? In Mandarin, the word crisis is called Wei Ji. I know I failed my Mandarin, but I'm doing my best, all right? Chinese teacher, right? Wei Ji is made up of two separate words, danger and opportunity. So what that says is the ancient Chinese knew that in any crisis, yes, there's danger, but it's amazing opportunity. So what's the opportunity right here? What can we do to make a tremendous amount of wealth in the next couple of months or years? Well, to answer that question, let's take a look at history. Let's take a look at the last 5 bear markets, the last 5 major bear markets. And I'm going to start with the year I was born. So I was born in 1974. That's 44 years ago, right? In 1974, there was a major stock market crash. Nothing to do with me, okay? I was only 0 years old, okay? So in 1974, the Dow Jones, the market in general, the S&P 500 was not really established at the time yet. So I'm looking at the Dow Jones. The Dow Jones that represents the US market collapsed 46%. And again, this took about 1.5 years. So this was a bear market that happened. Now, what happened after that 46% collapse? Well, like what I said, every bear market is followed by a bull market. A bear is always followed by a bull, right? So after the 46% collapse, what happened? Boom! From 1974 to 1987, for the next 13 years, the market went up 350%. Okay? So again, if you had known at a time that every bear market is followed by a bull market, what would you have done? That's right, you may have sold over here. So what I tell my students and what I do is this: the moment I notice a bear market, what do? That's right, the moment we're at the beginning of the bull market, you could sell all your stocks, all right, or you can go short on the market. And after it collapses near the bottom, all right, and now you never know where the bottom is, right? No one can tell where the bottom is, so you got to wait for it to reverse. I'm going to show you later on how we tell when a market's reversing. So the moment the market starts to reverse, it makes higher highs and higher lows. The moving averages begin to cross up and slope up. You have to buy back. You gotta buy before the next bull run starts, or you're gonna be left behind in the dust. All right. So if you had bought at that time, and over here you can see that boom, 350% return. Right. So that was 74 to 87. Okay. So the next bear market was 1987. So this was known as Black Monday. Have you watched The Wolf of Wall Street, a famous Hollywood movie? Well, it talked about this guy. What's his name? I forget. Played by Leonardo DiCaprio. Went into stockbroking in 1987. Market collapsed. Jordan Belfort got his name right. Okay, good. So market crash. This is the S&P 500. Market crashed 37% in just 2 months. And again, that was a bear market. Can you tell me, a bear market is always followed by a... That's right, bull market. So after the 37% drop, what happened? Ta-da! From 1988 to 1997, the next 10 years, the market went up 266%. So those poor suckers who sold in panic, oh my God, they sold it, they lost money, they did not dare to get in again, they would have missed that 266% bull run. So you gotta get back in right after the bear market, when a bull market starts. Now, when was the next bear market? You can guess, 1997. Or rather 1998, okay. So in August of 1998, we had known as the crash of 1998, all right. Market crashed 23%, and this bear market lasted for about just 3 months. It was just 3 months bear market, right? Very short bear market. And again, After bear, tell me what happens. That's right, you have got a bull again. All right. So in 1998, boom, we had the next bull market that lasted, well, just 2 years, 67% return, which makes it up anyway. So you can see after we had that 23% drop, that's 67.6% return. And in the year 2000, we had the dot-com bubble bursting. We had a dot-com crash, bear market came again, and the market fell 47%. And this was about 2 years. This was a 2-year bear market. It's a pretty long bear market. It's a pretty big bear market, right? And what happened after the 47% drop? Boom, market went up 101% from 2002 to 2007. Again, another bull market. Bull came back. Okay? And what happened in October of 2007? In October of 2007, we had the biggest bear market of the last 100 years. The biggest bear market since the Great Depression. It was known as a subprime mortgage crisis. And the market crashed 55%. And the bear market lasted for 1.5 years. And this was how I became famous in Singapore and Asia. Why? Because I wrote a book. And I wrote this book called Profit from the Panic. Right? And I wrote this book in January 2009, right at the bottom of the market. And when I wrote that book, and I put everything I had into the market, almost pawned my wife's jewelry, almost mortgaged my mother's house. I'm just kidding. Basically, I put everything to the markets, and that was how I made my fortune many, many times over, right? I went in just before this 346% return in the markets from 2009 to 2018. Now, people ask me, Adam, how did you know it was the bottom of the market? How did you know it was at the bottom? How did you know the bull run started? Would you like to know how I knew? Read the book. It's in the book. Okay, now good news. Now, the book is actually out of print, right? But I have the ebook version, and I'll be giving you guys a free ebook version at the end of this webinar. Not all of you, those of you who are lucky enough. Okay, so for the 25 lucky people who take action at the end of this webinar, you are going to be getting this book, Profit from the Panic, that was written and launched in January 2009, 10 years ago. And it explains exactly how I saw the bottom of the market and how I knew exactly when to get in before the next bull run. But I'll give you a little clue, right? Oh yeah, I'll give you 2 clues. Now, one reason I knew that the market was at the bottom was because the PE ratio of the index was 5 at that point of time. Now, historically, for the last 140 years, the lowest PE ever reached by the stock market is 5. That's right. So when the PE ratio is 5, it tells you that the market is at the bottom. It can't go lower. It's a historical fact. And how did I know that it was the start of the bull market? I used the moving averages. And it's something I teach in my courses. It's something that I talked about on YouTube many, many times. In fact, well, let me show it to you right here. So let's go back to our charts. And let's go back about 10 years ago. Shall we do that? Yeah. Well, let's go back in history then. Right. So where was the financial crisis? There. This was the financial crisis over here. Now, to do this, I just need 2 moving averages. I just need the 50 and 150. There we go. All right. So this was how I read, or this is how I read changes in trend. So I've talked a lot about this in my previous videos. I'm going to mention it again. So you can see the moment the 50 moving average, the blue line crosses below the green line, it is a downtrend signal. It's a signal of a bear market. Now, of course, they must be accompanied by the right slope. So when the 50 crosses below the 150, they must be both sloping down to confirm the downtrend. If it's sloping up, it is not a downtrend. All right, so this was a signal of the downtrend for me to get out of the market and to start shorting the market and profit as it collapsed. Now, over here, this was a signal of the new uptrend. Can you see why? the 50 crosses above the 150 moving average, and they both start sloping up. So that was a signal to get back in again. Now, if you get back in over here, you have gotten in a bit late. So I have some additional strategies I use to get in much earlier over here, which I'll talk about later in a webinar, or you learn it in my courses anyway, right? So anyway, so this was the entry point, and you can see it catches the bull run over here. Now you could have exited here and re-entered here and exited there. Exit there. You can re-enter here and catch this really strong bull run over here. That's right. So again, what I'm sharing with you now are the simple moving averages. Okay, and over here you can see again the change in trend, the 50 crossing the 150. So this is a confirmed downtrend pattern all the way down over here. All right. So again, as my student, don't worry, I'll be sending you these reports every week, every month to tell you where the market is now, what I'm doing, what I'm buying, what I'm selling, and where the market's going. So once you're in our community of investors and traders, no worries, right? You'll know exactly what I'm doing, what my students are doing, and how do you get in and get out at the best optimal time. So anyway, so that's 2018. So where are we right now? So as of October 2018, which is this year, like I said, the market reached a high of 2950. It's now at 25. That was the low. We're down 14% right now. Okay, so again, if it's a small bear market, expect at least another 6% down or 10% down. Expect another 4 months. All right, and the moment we see the market begin to reverse into an uptrend, that's when you have to buy like crazy, because that's how you create your next fortune when the bull market comes again. Now, here's the interesting thing. I've been talking a lot about the market in general, S&P 500, Dow Jones, right? How about individual companies? Now, here's the thing. Markets are very correlated. They're all kind of like moving together. And here's the thing. When the stock market goes down, 7 out of 10 stocks go down together with it. Okay? When the stock market goes up, 7 out of 10 stocks go up together with it. And many times, these companies are doing really well. They just go up and down purely because of emotions, just purely because of sentiment, right? So during a bear market, it's a great opportunity to buy very good companies that are still making a lot of money, that are still fantastic businesses, but they went down for totally illogical reasons. They went down purely for emotional reasons. And these are the best times to buy great companies. And a good example I can give you is Apple. All right, so Apple's a great business, right? We use their iPhones, their Macs, their iPads, and so on and so forth, right? And you can see that during the financial crisis, right? Now, what triggered the financial crisis? It was the collapse of the real estate market. Many banks were going bust, like Citigroup, Bank of America, AIG. They had all these toxic mortgage-backed securities that went bust, right? So rightfully, they were going down, right? But what did Apple have to do with the crisis? Nothing. People were still using their iPhones. People were still using their Macintosh computers. People were still using technology. But why did Apple go down 63% during the financial crisis? Why? Purely because of emotions. So that was a great time to buy Apple, because people were still using Apple. And you know that what goes down will always go up. And when it goes up, it is the good companies that will go up back. But the lousy companies will never go back up. So you have to know how to separate the good businesses from the lousy businesses. So you can see that during the financial crisis, it was an opportunity to buy Apple at a 63% discount. From $27 a share, you get to buy it at $10 a share. We call it the Great Wall Street Sale. Don't you love a sale in your town or your neighborhood? What happens during the sale? Like, I live in Singapore, we've got the Great Singapore Sale. People rush in to buy. The same thing in the stock market. It's the Great Wall Street Sale, because what happens after that 63% drop? Boom. Apple went from $10 to $220, 2,000% increase, because Apple's a good company, right? That's right. Okay. So the first lesson I want you to learn is this: the way to build tremendous wealth in the stock market is knowing how to buy great businesses in a crisis at the right time. Now, what's the first keyword? The first keyword is great businesses. It's got to be a good business. In other words, you got to buy a business that inherently has got a wide economic moat, has got a sustainable competitive advantage, that is still increasing sales and profits every single year, that is not affected by the crisis at all. But the stock went down purely because of emotions. Now, because of the current market sell-off, let me show you 4 stocks right now. And the first stock is JP Morgan. So JP Morgan's down. Okay? Next is BlackRock. BlackRock is the biggest asset manager in the world. They are down as well, about 20%. JP Morgan's down about 10%, right? Federal Express, FedEx, is down about 20% as well. GE, General Electric, is down, I don't know, God knows, like 70%. Okay? Now, one of the mistakes people make is they buy lousy companies in a crisis. If you buy a lousy company, guess what? When the market recovers, your stock ain't going back up. It is still fucked. Oh, sorry. It's still gonna be down there. So you have to know which are the good businesses. And that's exactly what I teach in the value momentum investing course. How do you analyze a company inside out to understand the fundamentals of the business, to only buy good businesses? So take a look at these 4 companies. Are all of them good businesses? No, they're not. JP Morgan's a good business. Why? They're still making money. BlackRock's a good business. It's still making money. So you want to buy these 2 in a crisis. Or rather, I want to do it. I don't know about you. Okay, I'm not giving you advice. I'm just telling you what I do, all right? Federal Express is still a good business. They just announced record sales and profits. They went down purely because of emotional reasons. So these are companies that I want to buy in a crisis. But again, disclaimer, I don't buy when the price is going down. Never catch a falling knife. Low can get lower, cheap can get cheaper. I always wait for the trend to reverse. And that's why I practice value momentum investing. I buy companies when they are undervalued, but when they start having momentum. Now, at the same time, would I buy General Electric, GE? No, I won't buy GE. Why? Because the company is no longer a great business. It was a great business in the past. It is no longer good business. It is losing money. Many of its businesses are in trouble. They are no longer the market leader. They have lost their competitive advantage in many sectors. So these are stocks that you think you're getting a good deal, you're buying it cheap. Guess what? It's going lower and lower, and it may never come back. So you got to know the difference, guys. So you have to know how to analyze a stock. All right? So as an investor, there are 7 steps to value momentum investing. And the first thing to do is to know, is it a great business? And how do I know it's a great business? Well, I look at a few things, right? Number 1, does it have consistently increasing sales, earnings, and cash flow from operations? Number 2, does the company have a positive growth rate? Is there a catalyst for future growth? Right now, GE doesn't have that yet. I don't know if it'll change, right? Not right now, right? Does it have a sustainable competitive advantage that protects it from competition? Does it have high and consistent return on equity? Okay. Does the company have conservative debt? I like to buy companies with low debt or no debt at all. Because companies that make money with high debt are really dangerous. Because the moment a crisis happens, that's how AIG almost went bankrupt. That's how Citigroup almost went bankrupt, because they had high levels of debt. So as an investor, you want to avoid companies that are too highly leveraged with too much debt, because they're really dangerous. So only when a company can pass my first 5 criteria, only then do I say it's a great business. So in the value momentum investing course, I go into detail showing you how I analyze and how I find these great businesses. So once it's a great business, do I buy the business? No, I don't. It's like you go to the mall, right? You find a fantastic jacket. You love the material, you love the brand, you love the quality. What do? Check the price. If it's too expensive, wait for the great sale, right? So the next thing is, once you know it's a great business, you have to know what is the intrinsic value of the company. What is it really worth? How do you value the business? And you want to buy it only if the price is right. The price is ideally below or near the intrinsic value. It is undervalued. We call that value investing. And finally, you only want to buy it when it's a great point of entry. Because again, you don't want to buy it when cheap gets cheaper, when low gets lower. You want to buy it when the emotions are reversing back up from bearish to the early bullish stage. So you only want to buy when the price is making a dip on the uptrend, or at the support level of a consolidation, or reversing into a new uptrend. Now, another great way to create tremendous profits in the stock market and to build your wealth is to identify good businesses that are hit by temporary problems and to buy them when they're selling at a discount because of the temporary problem that will eventually be resolved. And there are a lot of them right now. There are many of these opportunities as we speak. So let me give you an example into history. A great example that is of McDonald's. Now, McDonald's, as we know, is a great business. Been there for, 60, 70 years, or a long time, right? And McDonald's was selling at $91 per share, right, on a very nice uptrend. But something happened back in 2014. And what happened was there was a major food scandal, right? McDonald's faces declining sales after China food scandal. And what happened was this. McDonald's ordered meat, right, from a supplier in China, and the meat was expired. So when people ate the hamburgers and the chicken, they fell sick. Some of them even died, right, which was a terrible thing. And because of that, people were afraid of eating at McDonald's and even KFC at that time. So because of this temporary problem, McDonald's share price dropped from $90 per share to $78 per share. So that was a 15% drop. Now, as an investor, is that a good opportunity? Yes, it is. Why? Because it's a temporary problem. Would McDonald's eventually resolve this issue? Of course they would. And 15% drop is an overreaction because the amount of sales they lost is just a very small percentage of their overall global sales. So the market tends to overreact to bad news and overreact to good news. So when a market overreacts, that's the time that you need to take advantage of the market to buy a great company at a discount. So at that point of time, if you had seen an opportunity and you bought McDonald's, what happened after that? When the problem was resolved from $78 over here, you can see this was the drop because of the crisis. McDonald's then went on to increase 130% over the next couple of years. So again, fantastic opportunity. And like I said, right now in the market, there are many of these opportunities around. And let's take a look at some of them I'm looking at right now. And the first one is obviously Facebook. Now, Facebook, no doubt, is a great business. It's a monopoly in the social media space. And I should know because my company, we advertise on Facebook. In fact, we spend about $1.5 million advertising on Facebook every year, and we are increasing it year on year. And recently, Facebook has had a lot of negative publicity because of the data breach scandal that, the Russians were hacking the 2016 elections, and Facebook kind of like inadvertently helped them to to find the data of people, whatever the case. And recently there was a breach of their data. Because of all these problems, people are fearful and they're selling Facebook. So Facebook went from $225 a share down 45% to a low of $130 per share. So it's 45% discount. So again, you got to ask this question: is Facebook still making money every year? Yes. In fact, it's a debt-free company. It's zero debt. So Facebook passes all my criteria of being a great business. Now, is this a temporary problem? Yes, it is, because now Facebook is fixing the problem, and now it's an opportunity to buy Facebook at a discount. So the question is, what is Facebook really worth? Well, that's where, oh, by the way, that was the article. Facebook could face $1 billion fine for data breaches. Now, they're going to be fined $1 billion. Now, what's $1 billion to Facebook? It's nothing. You know why? Because Facebook makes $27 billion a year. They make $27 billion a year. What is $1 billion? It is nothing. It's a joke. It's an overreaction. So the fact that the stock dropped 40% is an overreaction to the problem. So what's important is you have to calculate the intrinsic value of the stock. So this is the calculator that my students get in the course, in the value momentum investing course, where I'll teach you how to value any business out there, to know what is the true value of the business. So you can see that for Facebook, it makes $27 billion a year in terms of operational cash flow. It has zero debt. It has got 42 billion of cash in the bank. It is growing at 17% return. There are 2.8 billion shares, and the intrinsic value is $207. So once I value the stock, I know that Facebook is worth $200 a share. That's the fair value. And it's now selling at $140. It's a sale. It's a fantastic opportunity. But again, like I said, when it's going down, cheap can get cheaper, low can get lower. So you gotta wait for the trend to reverse up. What I tend to do is, once I see higher highs and higher lows, now notice this, the market's making lower highs, right? Or rather, Facebook stock is making lower highs and lower lows. So this is what we call a downtrend pattern, which is what you learn in the technical analysis lessons in my course. And over here, you can see a slight change in trend. It's now making higher highs and higher lows. So the moment I see that change in trend, I start to take a small initial position. Not too big, a small position initially, because it could be the start of a new uptrend. But I wait for the 50 moving average to cross above the 150 moving average and seeing a change in moving averages to confirm the uptrend, and that's when I go full in. And that has not happened yet. All right, so I'm waiting for that to happen, but I've taken a small initial position in Facebook. Now, what other companies have been hit by bad news recently? Another one is a Hong Kong listed company from China. It's known as Tencent. By the way, Tencent is one of the largest technology companies in the world. It's even bigger than Facebook, right? Now, if you're not from China, you may not know this. Now, I'm not from China, but I know this, right? Tencent is one of the biggest technology giants in China. They are into online gaming. They're the biggest online gaming company in the world. And you know, in China, they don't have WhatsApp, they don't have Facebook, they hardly have Google, right? And they don't have YouTube, correct? Now, in China, Tencent is their version of WhatsApp and Facebook and Google all added together. So it's a giant, right? And you can see that it's a great business, making money every single year. But recently, what happened? The stock dropped 47%. Why? Because of temporary bad news. So what was the bad news? There you go. The Chinese government said, hey, our kids are playing too much online games. So they started to ban some of the video games. They started to delay the release of some of the video games that Tencent was releasing. So because of this bad news, people are panicking. They're selling the stock. Is down 47%. There you go. So Tencent sheds 230 billion from its stock on China's crackdown on online gaming. And again, it's a temporary problem, right? Eventually going to sort it out, right? What's the intrinsic value? The intrinsic value of Tencent is 311 renminbi, or Chinese yen. Now, if you convert that to Hong Kong dollars, it's slightly higher. Just multiply it by 1.11. Okay, so roughly, the intrinsic value is more than 300 Hong Kong dollars. And the stock is now selling at, ta-da! Well, it's now at $322. So currently right now, it's at fair value. It's not overvalued, it's at fair value, right? And you can see again the change in trend from the downtrend shifting into an uptrend, early stages of an uptrend pattern. So again, my students get my regular reports where I share with them all these opportunities in the market and what I'm investing in myself. Again, I'm not a licensed financial advisor. I'm not a licensed financial consultant. Okay, I'm just a great investor. I just make a lot of money in the markets. I love sharing my ideas, and people have to make their own decisions, but I share with you what I do basically. Okay, let me show you another one, which is Goldman Sachs. Goldman Sachs is the largest, well, not the largest, right? One of the most successful banks in the US, right? And recently they were charged by Malaysia because of a scandal they're involved in kind of like money laundering, right? Which they deny. So I don't know, right? But the stock again is now down quite a bit, right? Goldman Sachs stock is down about almost 40%. And again, this could be an opportunity to buy Goldman Sachs, but not just yet. Wait for the reversal in trend. And one latest one, Johnson & Johnson. There was some bad news recently that Johnson & Johnson has been hiding a report that the company knew for decades their baby powder had asbestos, which means it causes cancer. Oh my God, right? So because of this bad news, what has happened? Right, Johnson & Johnson has dropped 10%. But this is one example which I'm not buying yet. Because although Johnson & Johnson has dropped by 10%, it is still too expensive. Because once you value it using the intrinsic value calculator, you realize that it is still too expensive. So I want to see this stock dropping by at least another 10 to 20% more before I get interested, right? So these are the things that will make you extremely wealthy as an investor, knowing how to buy great companies at discounts because of temporary problems or because of the temporary bear markets. If you like this video, do click the subscribe button for more videos. If you'd like to find out about online professional forex and stock trading courses, do visit piranhaprofits.com for international students. And for our students in Asia, we have our live stock trading and investing courses at wealthacademyglobal.com. This is Adam Khoo signing off. May the markets be with you.